They have never split their shares through the years since the Berkshire Hathaway was publicly founded as a holding company, and they are selling for a cool $715,000 a share right now. So they're very, very expensive. The Class B shares are what most of us normies buy, and those were established in 1996. And so
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by
Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Today, we're going to talk about the different share classes out there. When you own shares in a company and your vote counts for not much, what does that really mean? And how does the economic stake of somebody who owns the company is smaller, but they have, a bigger stake in the business? How does that really work? So there's been really fantastic investments over the past decade, companies like a Google, a Meta, a Berkshire, that have different share classes. And maybe we're not familiar with them. We don't understand if they are, how we can partake of them or can't, and what kind of impacts they have on the businesses. So we thought we'd talk a little bit about that today. So my preamble over. Andrew, would you like to start talking about share classes?
Yeah, let's talk about share classes. If you're absolutely new here, shares, if you want to buy part ownership in a business, you buy shares, and every company is kind of split into a different number of shares outstanding. So, it really doesn't matter what the number of shares outstanding is. It's just going to affect what the stock price ultimately is. But if you're buying a share, you're buying a share. That's really just how many slices is a company split into, and those are the shares. Now, where we get into share classes becomes more interesting because when you have part ownership of businesses, again, every company can be set up differently. Some businesses have majority ownership. Some of them have kind of like in the middle of like a 30% owner, like Berkshire Hathaway. Buffett owns around 30%. So majority ownership would be like over 50%, which means you basically control, in essence, you control the entire business. And we can talk about what that means exactly. But that would be a majority owner. And then somewhere in the middle is like a Buffett at 30%. And then you have a lot of public companies where there's really no major owner. The biggest owners are like the Vanguards, the Fidelities, the brokerages who are holding shares on behalf of a bunch of the general public. And you look at the documents and you see that they are actually the biggest owners, and a CEO might only own 0.002% of a company because it's so big, right? So it goes in all ranges, types, sizes, but it does have implications because one of the things, yes, my 3 shares of whatever company I own, me voting on it doesn't matter. We all get that. But the bigger picture is if it is possible for somebody to vote against, like let's take the Warren Buffett example. Warren Buffett has always been fantastic. Like I don't think there's ever been a big movement to vote him out. But if knowing he only has 30%, there could be in the future some sort of movement where if he does something atrocious, then it only makes sense that everybody else would vote to take him out of CEO role. Obviously, he's not CEO anymore. Just an example. So that's the way I think about it, at least. Like, yeah, my share doesn't matter. My vote doesn't matter because I'm not moving in the billions of dollars of ranges. But the opening is there for other smart people to take activist stakes, and we could even talk about activist stakes because that's fascinating too, but to take activist stakes and force change. And those types of changes are not possible if you own a company that's majority owned.
Yes. Yeah. Totally agree. That's a great explanation. I think the way I try to think about it is that there's I guess, different tiers of ownership. And depending on how the company is structured, there can be different tiers, and there can be different rights associated with those tiers. So you can have voting rights, or you can have economic rights. So you get a bigger share of, any sort of pie that they, a dividend or assets that they spin off. If you, depending on your economic rights, you may get a bigger share. And to Andrew's point, yes, us owning a share of Berkshire Hathaway in the grand scheme of things has really not much to do with it. But like he said, when it comes down to, I guess the way we should think about it is, when we're investing in a business, we're really investing in the people that are running it. We're investing in the business and the assets that it contains, but we're also putting our money behind the people that are running it, that they're going to make decisions for the business that are going to be best for the business and for us. And depending on how the ownership is set up, and we'll talk about this in examples of how this could be detrimental to investors. If you put all your faith, if you're betting on Meta, you're really betting on Zuck, because of the way the ownership is set up of that business. And if he isn't driving the bus well, then you're going to lose money, or you're not going to do as well. And that's one of the things that has set Buffett apart, is because of the structure of their company. He's, even though he only had 30% ownership of the business, he still ran it like he was the owner of the business. And to hit Andrew's point, if you wanted to take him out, there were opportunities to do so if you wanted to. With other companies, there may not be. And so that is something to be aware of when you walk into an investment. Most companies have one class, and so this really isn't an issue. But to what Andrew was saying, Vanguard, BlackRock, these companies, they don't own those companies, but they hold a vast portion of shares for individual investors or other funds for us. But there isn't any one particular person driving the bus per se. I think about a company like a Visa or MasterCard. Both of the CEOs own like 0.01% of the business. So they're really not in a position to, if somebody wants to come in and oust them, there's not a whole lot they're going to be able to do to prevent that. Whereas a company like Meta is going to be able to fight that off, or Zuckerberg would be able to fight that off much, much easier.
Yeah, great points.
All right. So why would somebody starting a business create multiple share classes?
That's a great question. And it's becoming more and more common now. Seems like we talked off air, like Snapchat is kind of went this path. Google has went this path. I really, I really don't have a good answer for this. I don't know why they do it this way. All I know is that as investors, we can use a proxy statement and we can figure out what the actual voting power is of shares, regardless of how it is actually structured. But maybe you have like better insight into that particular question than I do. Like, do you know why companies do it?
I don't. I think from what I've read and just looking at different businesses through the years, I think it really comes down to how the company is set up and who is running it, and how much control or the founder really wants to have as the business goes forward. You think about a company like Facebook or Meta. Zuckerberg obviously is invested in the business, and he wanted control of the business from the get-go, and that's what he's retained. And the way he set up the share structure, the classes allowed him to maintain control throughout the life of the business. And he will probably, some companies like a Visa or MasterCard or even a Microsoft. I can't speak to early Microsoft, but today it's not really, there's no founder involved. And so the ownership share structure is very simple. And so it just makes it feels a little bit more generic, and it feels a little bit more like there's not as like Satya Nadella is definitely driving the bus, but if he stumbles, then it would be a lot easier to get him out than it would be, somebody like, the guys from Google or Zuckerberg. So it just, I think it really comes down to control issues, depending on how the company is set up. And this is completely speculative. So I would imagine that younger, newer companies probably have more control based in the founder today than they did 30 years ago.
Yes. Yeah.
If you think about,
to that point,
go ahead.
sorry, go ahead.
No, go ahead.
Like you were able to build a business so much faster with technology where by the time they get to IPO stage, Zuckerberg was young by the time Facebook went IPO. The co-founders of Google were young. It's, you just didn't have that as a possibility because businesses couldn't scale that fast before the internet.
Yeah, for sure. I mean, kind of thinking a little bit more about it, Steve Jobs was ousted from Apple, and I'm guessing because of the share classes they had, he didn't have the ability to fight that off because he didn't own enough of the business, and he didn't have a share structure set up that he was a majority owner and that people couldn't vote him out. And so because of that, then he made himself vulnerable at that point.
Yeah, there's a great episode by the Acquired podcast. They talk about Meta and the whole backstory. It's quite long, so if you don't have the fortitude, then maybe pass on
6
that
hours.
recommendation.
6 hours long. So yeah, just buckle in.
But there's speculation on their part that there was a point in time in Meta's history where everything went down and like stock went down like 80% or something ridiculous. And they speculate if Zuckerberg did not have the control at the time, then he wouldn't have been able to do things that went against the grain, that other CEO would have come in and been ousted and not been allowed to let that plan bear fruit. It's an interesting, I mean, we could debate it probably till the end of time, but with technology, when you're in a technology company, do you need to be more visionary than if we were selling salt and pepper shakers, and maybe that's some of the reasoning for having that founder control. But you could easily argue that maybe that's a little egotistical at the same time, that one person with one person's decisions would shape the direction of 100,000. We can speculate. So I think it is interesting. But as investors, we 100% need to be aware. And going back to the Meta thing, when Meta went down a lot in 2022, it was because they were spending like crazy on the metaverse, and that was completely visionary and there was no ROI on that. And so I think a lot of the shareholders just got freaked out. They're like, how many more billions of dollars are going to be burned on this vision that didn't come to fruition? So definitely something to be aware of. Absolutely.
So maybe let's segue and talk about maybe some specific companies to give some examples of this. I think probably the first one I'd like to talk about would be Berkshire Hathaway, and talk about they have, a lot of people don't know this, but they actually have a dual class share structure. So they have Class A shares and they have Class B shares. So the interesting thing is that the Class A shares are the original shares that Berkshire issued when they first went public. They have never split their shares through the years since the Berkshire Hathaway was publicly founded as a holding company, and they are selling for a cool $715,000 a share right now. So they're very, very expensive. The Class B shares are what most of us normies buy, and those were established in 1996. And so they don't have, the Class B shares have like 1/1500th of the same voting rights as the Class A shares. So you're not really getting much input on what happens with the business. But if you're only buying 3 to 5 shares, let's be honest, that's not really why we're investing, is to have control of what happens in the board. But Buffett did this really for kind of a twofold reason. Number one, he wanted to prevent financial products from repackaging Berkshire and charging fees for that. So he wanted to create two different share structures, which would kind of help prevent them from doing that. And then he also wanted to make ownership accessible to smaller investors, i.e., us. So as the share price grew and grew and grew, he recognized that most people couldn't invest in this, and he wanted to expand the shareholder base to include, more air quote normal people. And so that's why he decided to issue these additional shares.
Which is ironic now that with fractional shares, that is a moot point.
I reckon. Yeah, right. Yeah, exactly. Yeah. I mean, the voting power, there is a difference between the A and B, but it's, because Buffett is such a large ownership stake in the business, it's pretty much symbolic. So I mean, it is, Stephen wasn't aware of this. When I was talking to him last night, he was shocked that Berkshire had a second, share class. And he was like, it just blew his mind when we were talking about it.
So let's talk about some of the voting then. When we're talking about voting power, we're talking about control of a company. What does that exactly mean, and how does it practically play out in most corporate situations?
Well, it can play out in a lot of different ways, but I think probably the things that most come to mind would be the direction of a business, whether the company is going to maybe change its business structure, or if it's going to change what it is that they offer or sell. That could certainly be up for discussion and voting. Anything like share buybacks, authorization to acquire companies' public shares on the public market has to be voted on. Things like pay for managers has to be voted on, as well as pay for the board members. All of those things have to be voted on, and they have different committees that they set up as part of the board breakup or breakdown, and they have different people, the different CEOs or different C-suite managers may have different levels of committee responsibilities. And one thing to always keep in mind when you're looking at the proxy and kind of determining some of those things, a big no-no or red flag is if the CEO and the chairman of the board is also on the compensation committee. That is not a place you want to see, because you do not want the person in charge of running the business and control the board also deciding how much he gets paid or she gets paid. That you do not want. I came across one company. I always forget if it's Blackstone or BlackRock. So, but that CEO is also the chairman of the board, is also the only committee member on the compensation board. So he runs the business. He also decides how much he gets paid, and nobody can dispute that. So that's not great. So if you see that kind of thing, just be aware it's not a great place to be. Are there any other things that I maybe missed or that you think would be good for people to know?
Yeah, all of those things, you covered basically the biggest ones. Another one is just electing directors. So the directors and the board of directors, they have to stand for re-election, or somebody will nominate a new board of director. And something that shocked me when I first learned about it, because I didn't grow up in a boardroom. I know that might be hard for you all to believe, but
you did?
A lot of the board of directors are from other companies. So like they call them independent directors. And so like Tim Cook is on Nike, or he was on Nike's board of directors. So you'll get this like cross-pollination, and they won't, sometimes they'll pick some people that are in the industry. Sometimes they'll pick people that are outside the industry. You get good ideas, discussions, conversations when you have that diversity of experiences and all being brought to the table. And so, the director who goes on the board of directors is voted on by the shareholders. And then those board of directors, like you were saying with compensation, they will keep the CEO in check. They will make sure he's being paid fairly, all of those things. And when that's all the same person, CEO, compensation, chairman, majority shareholder, there's not a lot of wiggle room to enact change if you're not happy in that situation.
No, not at all. Not at all. Are you familiar with the structure of a company like Google? Like what
I'm
they're
not.
okay. I can share a little bit. I'm not 100% on this, but so Google has three classes of shares. They have the Google A, the Class A shares. These are the GOOGL, and this is what most of us buy. So this is one vote per share, and it's publicly traded. So this is what we all see. If you go to your brokerage and want to buy Google, that's the share you're buying. There's the Class B shares, and this is 10 votes per share. And this is held by the founders. So this is not publicly traded. This is what Larry Page and Sergey Brin own. And this is what gives them control still of Google. And then there's a C shares, which has 0 votes and it's publicly traded. Not entirely sure why it would buy 0 votes, but okay. But those are the kind of that's how Google has set up their class structure. And so the Class B shares still allows them to retain majority ownership of the business and allows Larry and Sergey to still, control the puppet strings of what happens with Google, even though they're not let me rephrase that, hadn't been actively involved in the business for a while.
Yes. Yep. Exactly.
Yeah. And then I guess the last one we could throw out there would be Meta. So Zuckerberg, as we've mentioned before, is the major shareholder he's the major owner of the business. He owns approximately 60% of the business and 60% of the voting power of the business, I should say. And so that gives him very dominant control. So there's 2 classes of shares. There's the Class A, which is 1 vote per share, public. That's what we buy. And then there's the Class B shares, which he owns the vast majority of. And so that's what gives him the power.
Do we talk about Elon?
I think we should. I don't frankly know what the share structure is for Tesla. I'm guessing you do.
No, I do not, but we can look it up. And I think it would be interesting because I know there was a lot of talk. Maybe you can fill us in on like what the general narrative was around Elon and compensation and things like that.
So recently he was voted a, shall we say, generous compensation package by the board of directors. And I want to say, don't hold my feet to the fire, but $1 trillion, $1.5 trillion, somewhere in that range of money he was supposed to earn. Of course, the initial hullabaloo was people weren't reading any further than he was going to make a whole lot of money. What really needed to be kind of dug into was there was some pretty steep standards or incentives that he had to meet before he could achieve those kinds of numbers. And that I don't remember the specifics of, but it was outrageous revenue growth, outrageous market cap numbers compared to where the company is today. I want to say 5 or 6 times, if not more, maybe 10 times the level that needed to be achieved for him to achieve that kind of payout. So from a bird's eye view, it looked super extreme, but then when you dug in a little bit further, it looks even more ridiculous because like how could the company even achieve those kinds of numbers?
So I had trouble finding the proxy statement, but I was looking at the Dev A14A, which is not quite the proxy statement, but it's just a bunch of screenshots from Twitter, which I thought was funny. I've never seen that on BAMSEC or a financial document that has a bunch of screenshots from Twitter. Like Elon's retweets on here. There's a tweet from Tesla. It's literally right here in the Dev A, the Schedule 14A. This is so funny.
Funny.
Okay. So I did find the proxy statement. So Elon owns 19.8% of Tesla. And then it's Vanguard and BlackRock. And I don't see anything about multiple share classes. So let me search. So if you're doing this homework at home and you're looking like a crazy person at all this different compensation, you can do Control F to search for voting power. And because, like Dave was saying, with like Google, for example, they might not necessarily own 51% of the company, but if they have voting power for 51% because their B class shares give them the voting power, then that's what you really want to know. Because a proxy statement will tell you voting power and how much percent of shares you own, as well as the different classes. So based on what I can see, and I didn't read it, I was just skimming. So take that for what it's worth. Doesn't look like there's any changes between voting power and how many shares you own. So it seems like it's just a 1-to-1, just your standard kind of share structure for Tesla. So interesting story. Get the popcorn out for sure.
Right. Yes, for sure. Yes, for sure. I think that's really interesting. It to me, it shows that he has full confidence that he can run the company and he doesn't need to worry about control. And although I'm sure he's quite the control freak, and that certainly seems to be true, he has enough confidence in his ability to do good things with the business that he didn't feel like he needed to have the same. And so maybe you could argue that maybe Zuckerberg didn't feel the same confidence level and felt like he needed to protect himself by having the dual share class. It's, I don't think we'll ever really know unless we specifically ask him. And I don't think Mark's taken my call. So let's just have to, speculate on that.
Not at the moment. So I am curious then, as an investor, somebody who's researching lots of different businesses, maybe you can kind of talk about Watsco versus like some other business in your portfolio. We've talked a lot about things that we don't like to see, like the compensation conversation. How are you approaching all of this information with share classes, ownership, voting power? How does that factor into your decision-making process, your research process? And then maybe at the end, you can talk a couple examples of how that's affected one company versus another.
Well, it certainly adds, I think when you're trying to research the business, it certainly adds a layer of complexity, because you not only do you need to know who the people are that are running the business, you also need to know who has economic stakes and who has voting stakes, and how do those two commingle. And it all goes back to one simple question: do you trust the person running the business to do the right thing? Are they going to do what's in the best interest of me as a shareholder? And I'm not saying that necessarily selfishly, but I'm saying that, like, are they going to behave in a manner that is going to benefit shareholders? So if I put my money with Watsco, is, the owner and his son, are they going to do the right thing? When the owner passes away and the son takes over, do I trust that he's going to continue being beneficial to me as a shareholder? And if I can't come to that conclusion, it makes it really, really hard to want to invest in the business. When you're investing in companies that are a little more open about the voting power / compensation equity or economic benefit, like a MasterCard or a Visa or a Microsoft or others like that, it's a lot easier because that layer of complexity is removed. And so it just makes it easier to assess, okay, do I think that A, the company is a good business, and B, the people running it are going to do what's best for shareholders going forward? And if that's happened in the past, it's likely to continue happening in the future. Whereas if it's more founder-led, then you're really betting on the founder, because you're really betting on whether that person, A, will continue to do what they've been doing, and because they probably likely have a higher percentage of voting power, they are also going to have a bigger share of economic benefit, which I'm okay with. But if I don't trust that they're going to do the right thing, then it's going to make it a lot harder for me to invest in the business. And I think, not to put the spotlight on Elon, but because he's erratic, to be kind, that can be one of the challenges with investing in a company that he's running. There's no question he's a brilliant guy. There's no question he's talented and he knows what he's doing, but he's erratic. And so if the ownership structure was situated such that he really went off the rails and there was no way to remove him, it'd be really hard to invest in that business based on that one, factor. Whereas if he goes off the rails the way it is now, there's a very high likelihood that an activist investor would come in and force that person to be removed, and that can help alleviate some of the maybe the erraticness or the worry about whether this person is going to continue to do a good job or not.
Yeah, maybe from a high level, like activist situation, what does that mean? What does it kind of look like practically in the stock market?
I think the easiest way to think about it is there's a board of directors that are in charge of all these various parts of the business, and they have a certain ownership of the business, and they get nominated to be on the board by board members or the CEO or your shareholders. And what will happen is that an activist investor, so Bill Ackman is a good example of this. He became an activist investor in Darden many years ago. And what he did was he and his Pershing Square, his fund, bought a ton of shares. And so they became a larger percent ownership of the business. And that allowed them to be basically voted in by other shareholders. Because of his share of ownership, he was able to be voted onto the board, and then he was able to start enacting changes that he thought needed to be happening at the company level to extract more value for shareholders. Of course, for him, yes, there's certainly a selfish element to this, but he was also doing it for other shareholders because he felt like that this was a very profitable business and it was being mismanaged. And he wasn't able to, if Bill Ackman calls, I'm guessing most CEOs are probably going to take his call because he's a well-known, investor with a lot of money at stake. So if he's talking to the management and they're not listening to him, that's really his only recourse. Is if he wants to stay in the business, then he could become an activist investor. And there are certain funds out there now that this is part of what they do, is they become activist investors in different companies, and they search out businesses to try to find companies they think they can take an active participation in and become board members and affect change at the company level. Chipotle went through this. I know Darden did. There's been a bunch of companies, the
Crown Castle.
there's been companies like that have gone through big changes. I remember Herbalife back in the day was another one that Bill Ackman got involved in. That is one way that larger shareholders can try to enact change at the corporate level, is by buying shares, getting voted onto the board of directors, controlling more than one or two seats on the board of directors, and then they have voting power, and then they can start to force the CEO either to go away or to make changes that they think will be beneficial for the business.
And that can do some great things for a company stock too. It really depends on the situation. Obviously, everybody's different. Every situation's different. But if you can eradicate some of the causes of the failures and then kind of start with a cleanish slate, you will see some stocks that will go higher as soon as an activist has made their presence known. And they do that in various ways. And so if you're a struggling shareholder and you're sick of seeing your stock down for 3 years in a row while the rest of the market's screaming higher, sometimes any change is just a welcome change. And you can see that play out I don't want to say like quite often, but it happens enough where it does play a role. And chances are, if you buy enough stocks, one day you will have one that goes through a situation like that.
Yeah. Yes, for sure. And this is why part of why also reading, or at least looking through the proxy or the I guess corporate ownership of the business can be helpful. It doesn't mean you have to read it every day or every time it comes out, but just at least familiarize yourself with what's going on with the business so that you can kind of stay up on who is on the board of directors when there is any activist play going on with the business and whatnot, because it will affect your business for sure.
That was one of the key parts of my checklist I always used was, okay, what's the ownership? Are we talking majority or are we talking minority?
Yeah. It's very, very important because again, when you're investing in a company, you're investing in the people running it. And it's not just the assets or the business itself. It's also the people that are running it. And you're putting your trust that they're going to continue to do the things that make that a successful investment. And, if their track record is poor or if they have a history of doing poorly, then you got to ask yourself, why would I give these people my money?
Yeah. Yeah. The tough decisions. So if you are a investor, stock picker, you want to buy and hold stocks for the long term, and this entire conversation has just freaked you out. Like, if it sounds confusing or just like way too in the weeds, what kind of advice do you have for thinking about all these share classes and everything?
Yeah, that's a great question. I think probably the way that I try to think about it and the way that I've tried to approach it is try to, I guess the first level is try to understand, educate yourself on what the structure is of the companies. So in other words, learn what a proxy is, learn what information is in the proxy that's important for you. And we have written about that at einvestingforbeginners.com. You can search for the proxy statements, and we've written about what you should search for and those kinds of things, and learn about how the companies are structured, because that is, as we've talked about today, is very important. I write about that a lot in the write-ups that I do for Value Spotlight. It's something that I think is important. I discovered this, I guess, importance 2 or 3 years ago. And so it's something I try to incorporate when I'm looking at every company, is just try to give people an overview of what's going on with a company like Taiwan Semiconductor or MasterCard. And while these aren't ground-shaking, earth-shattering revelations, sometimes you can learn something that could be really interesting to know about that business, and could be a bit of a KPI that you can kind of track as you're following the companies along, to make sure that the things that you thought at the beginning are things that you will see as it continues to go on. I guess those are some of the things I think about. What about, do you have any tidbits you would recommend?
If it stresses you out, just stay away.
Yeah. Oh, there's that too.
Yeah. Like, just don't buy into stocks with majority ownership and be done with it.
Yeah. That's true. You don't have to swing at every pitch, right?
Yeah.
Yeah. You don't have to swing at every pitch.
Give us a baseball player who did that.
Swang at every pitch?
Did not swing at every pitch.
Did not swing at every pitch? Well, that would be easy. That'd be Barry Bonds. He did not swing at every pitch.
That's true. I thought you were going to say Ted Williams. So
no. I think I would have to verify the numbers, but I think Barry had a higher walk percentage than Ted did. Yeah, I think that's so. Amazing. But I would bet my life on that, but I would not be surprised if it was.
I wouldn't be surprised either. There's not very many players who get walked with the bases loaded to tie a game.
No. I think one year he had over 100 intentional walks, and he had over 220 walks for the season. So yeah, Like the
Right.
closest person to him was like, half of that. So, yeah.
Right. Well, hey, there is a little correlation there, right? Barry Bonds, massive power. Aaron Judge, massive power.
Yep.
They take a lot of pitches. They don't swing at a lot of pitches. And then who was the GOAT investor who did all that? Warren Buffett.
Yeah.
Swing at nothing and had one of the greatest track records of all time. So
Yes.
I think there's something there. Food for thought.
Yep, I would agree.
Coffee mug proved me wrong.
All right, folks. Well, with that, we will go ahead and wrap up our discussion on share classes and their importance. And with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety, emphasis on the safety, and we'll check you out next time.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.